let's look at Russia. First off, read this disclaimer carefully. We can find the ETF in question here. It's under the stock markets, and we are going to Eastern Europe, Russia. Here you can see the distance from the 52-week low, distance from 52-week high, still minus 31%. Here is the beta, assets under management, volume, and the ETF is called Vanek Vectors Russia ETF. RSX is the ticker. Here we got some GDP data, consumer price index. Here you can see the total tax rate and forested area. Let's jump into the charts. This is the mega big picture using weekly data points. Here you have the lead up to the big global recession in 2007/8. Huge crash. Let's actually measure that implosion. So from here to there, that's like minus 81%. Huge bear market. Something that's rather apparent here is that even though the S&P 500 has made a very full recovery after that bear market, many countries around the world, huge economies, they did not make that recovery. Hence, if we look at the SPY, okay, this looks very good and healthy, but this isn't, it doesn't really give you the real picture of the global financial markets. If you look at the VGK, that's the Europe ETF. That one is significantly away from the all-time highs. Look at China, also a very important economy. This is the high of before the financial crisis, very far away. This is a very damaged market. Look at EVJ. Japan is also very much a damaged market. Very different picture. I mean, let's look. Let's just go back to Russia. Okay, so my point is that do not be deceived by the S&P 500. Just because that one has gone up and made new highs, that doesn't mean that there has been this recovery. In the big picture, looking across markets, the market post the financial crisis has been very sick. Hence, we didn't really fix the problems from that huge implosion. The interesting thing about Russia and many of the other markets is that they arguably give us a more honest picture of finance and the health of the markets. There are some interesting behavior here. If you look at the recent low during the recent implosions, you can see that we went all the way down here, meaning Russia has almost revisited the lows of the the housing bubble crisis. Something that's very interesting to observe, that is this accumulation distribution line. Let's actually make that one a bit thicker, like that. So you can see that, well, maybe that's a bit excessive, one move down. So even though you've seen that the market now is currently much lower than this, there's been this overall increase here in accumulation. That's interesting. Obviously, there are many people who are seeing value here in Mother Russia. And because Russia has been in the crossfire of all kinds of political machinations back and forth, it means that that has pushed the price of the stock market down quite significantly, along with the challenges with the fossil fuels business. Hence, the Russian stock market is sort of like the inverse of the S&P 500, the American stock market. In this stock market, there is arguably excessive bullishness, euphoric behavior, even during even notwithstanding this latest pullback. a lot of this is very euphoric. It is based on this extreme faith in the future, where very few bad news are priced in. Russia, this is the polar opposite. A lot of the bad news, worst case scenarios are already priced in. Of course, if the global economy continues to unravel, that will be bearish for Russia as well. The big question is whether this right here is a much better bargain from a very long-term perspective. From a technical standpoint, obviously the bears are for all intents and purposes in control, even though there's been a significant pullback. Looking at the latest candlesticks, you have this this candlestick here for for this week. It was not very good. You can see that we went all the way up here and closed low, and this is a very bearish candlestick. Hence, the bears, they could, get up to some new shenanigans. The statistical correlation between the S&P 500 and the RSX is, 69%. If we go here to daily data points, let's load the data. You can see that we are below these like the 200 and 100 day moving average. We have been able to break above the 50-day moving average, but that one was negative. Hence, it doesn't take that much to break up above a declining moving average. The purple 20-day moving average, it was functioning as a potential support level, but it's not like a solid support level here. You can see that we are currently sort of hanging off a cliff here. Okay, so just to sum up, am I bullish on the Russian stock market at this point? That would be a stretch. My central argument here would be that I think that the Russian stock market is much more rationally priced than the American stock market, and from a long-term perspective, Russia is making quite a few very strategically beneficial decisions. The entire economic and political system in Russia is far more long-term oriented, while the American system is very short-term, very much about the short term. And I do think that from a long-term perspective, there are substantial benefits to having that long-term horizon. And that's not simply a benefit for Russia, but it also is a benefit for countries like China as well, and other countries. Another key point is that Russia is a big player in the massive oil price war that we are seeing, and Russia is able to withstand lower prices than the USA. And there is some talk that the Saudis and the Russians are basically conspiring to crush America's position in the fossil fuel business. Here is Saks.com. They have a number 3 hold on Russia. Here you can see the ETF.com website. Assets under management, $885 million US. Average daily dollar volume, $200 million US. And you have a decent options market. Number of holdings, 28. The price earnings ratio is around 5. Let's actually compare it to the S&P 500. I guarantee you that it is not 5 for the S&P 500. Well, let's load the website to get the SPY, which is a very good way to look at. Okay, so the price earnings ratio in USA is around 18, price book 2.7, and here, price book is 0.96, so pretty substantial difference. As far as the sector breakdown, huge in energy, basic materials, and financials, and here are some of the biggest companies. Gazprom, huge, gigantic oil and gas company. Of course, many of these companies are, I just do not know what they are up to, but it's easy to figure out. Let's now look at a very interesting topic, and that is the big whales. Because some players in the market, they make a much bigger splash than others. And here are some of the big whales. I also like to call these the river makers. By moving huge sums of money, they have a great effect on the market's direction. And we saw something very interesting with the accumulation distribution line with the Russia ETF. As an investor and a trader, you are definitively at the mercy of these actors. Hence, if you see like a big dip in the market, or let's say in a specific stock, if you take on a position, you will not, have a big impact. But when these players start buying at a low level, even though the stock made a new all-time low, they can, by the size of that position, make that the ultimate low. They can make hammer candlesticks. Yeah, when they make a move, you will notice. And some of these, they definitively cooperate to impact markets. And challenge them at your own risk. Here are some of the different whales out there. You got sovereign wealth funds, and Norway's sovereign wealth fund is over $1 trillion in market value. You got pension retirement plan managers, you got mutual funds, hedge funds, and they also actively use derivatives, hence they can make a huge splash. You got the central banks, both public and private. As an example, Edmund the Rothschild Group is a private bank. Derivative traders, referring back to the market power pyramid that I have shown in a previous video. I think it was a video actually about, it was one of the cryptocurrency videos. And you have investment management firms and family offices. Let's quickly have a look here at the S&P 500 and some of the key markets heading into the coming week. So let's look at the SPY, see what's going on here, zooming in on the daily data points. Okay, we did see pullback this week. We did actually close below this 10-day moving average. For all intents and purposes, the bulls, they do have a nice position here, but it is certainly a lot more fragile than it's been in a while. Here we have very consistent buying, small dips. Here you can see that the pullbacks become deeper and more frequent. We do have the 20-day moving average here coming in as support. The coming week will be very interesting, because it will be to a large extent about the 20-day as a support level and resistance here from the 100 and 200-day moving average. I am definitively in the camp that think that the recent bounce in the market is a bounce within a bear market. But then again, I do not want to fight the Fed. I just do not want to get into that. Hence, I wouldn't want to turn bearish in practice until I see that reflected in price action in the chart. Because the Fed is a pretty big whale. As far as the Fib retracement, this pullback here, it happened almost surgically here at the 61.8 retracement. Which is basically in line with a classic bear market rally. So that's the S&P 500. Let's look at the TLT, the bond market. Here you can see that we've had this major run. Then we are consolidating the gains, slipping a bit below here the 20-day moving average, and even like the 5-day moving average here is a resistance level. For all intents and purposes, the bulls here are in control, but it's slipping a bit. But then again, the gain has been rather substantial. From here to where we are now, that's 24%, which is pretty decent for the 20-year treasury bonds. Let's look at gold as well. Gold had a major run. We've seen some big moves in the GDX. You can see that there's been some pullback here, slipping below the 20-day moving average. I would not be surprised to see a pullback maybe to the 50-day or something like that. if we look at the history of gold, pullbacks, they are rather frequent. If we look at the accumulation distribution line, it's been rising throughout this rally, but you can see that this high here, the AD line was meaningfully higher. Though we can see here that the RSI got rather excessive here, so this was a bit euphoric. This is a lot more measured. Hence, I would say that this rally here is much more healthier than this. And that is also reflected in the pullbacks. Here you got these huge rallies, but deep pullbacks. Here you got consistent, relatively consistent rally, and measured pullbacks. This is the kind of price action I like to see. Yeah, we've looked at some of the major ones. Let's just look at Bitcoin just for good measure. Bitcoin made tons of progress. Let's actually measure the gains from this low to this high. 78%, that's pretty tremendous. Yeah, a lot of gains. This is maybe not that measured. This is not like a very rational, calm rally. We have gotten overbought. There is still some distance to clear this high, because clearing this high here, that would be like a very strong breakout, and yeah, it would be very, very bullish. The challenge with these kinds of moves is that there is always the risk that we run out of fuel at inopportune time, because that is like because the financial markets is also a bit like chess. You need to play your hand in a very intelligent way, make the right moves at the right time, and if you become a bit too cocky, that can put you in trouble. I think this is potentially a bit cocky. It would be prudent to have some pullback, finding support here at like the 100 and 200 day moving average, calm down a bit, and then make that push. I would like to see that, but of course I cannot decide what the traders are going to do. But that would be a more strategic way to clear this hurdle. If you do just push out here, like very euphorically, there is always the risk, that people will because the people here, they've made gains, and when they do see the levels get up there, there's a higher risk of profit taking. I would rather want profit taking to happen in a sideways action than after a euphoric move that can create a self-reinforcing pullback. Okay, that was some of the markets. It's going to be a very interesting week ahead. Whatever you do, of course, let the trend be your friend.